All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And now we're switching our focus to the energy sector, oil and natural gas, as we're chatting with Josef Schachter. Josef is the founder and editor of the Schachter Energy Report, as well as writes the Ion Energy Report, which is now on Substack. The Schachter Energy Report focuses a bit more on the companies, while Ion Energy focuses on more the macro, what's going on in the oil and natural gas space. And Josef, because it's the end of the year as we're recording this before New Year's Day, we are going to recap 2025 and look into 2026. We've been chatting with you off mic, and quite frankly, I was coming into this call thinking that the oil sector has been pretty disappointing. Technically, oil traded at the lowest price level that it has all year in December, bounced a little bit in the later part of December, but oil's been really in a downtrend since the highs in 2022, and prices have been broadly cut in half over that period. Really seems like the oil sector just continues to be under this, in a way, relentless pressure, but the stocks, weirdly enough, are holding up quite well. And as we were talking off mic, a number of winners in the oil sector. So, Josef, just from the oil price aspect, look, it's been a multi-year downtrend. Is 2026 finally going to turn this downtrend?
Well, let's start, recapping 2025. If you recall, at the beginning of the year, price of oil was $79. And I started seeing that there was an inventory build in the United States. Demand was weakening for gasoline and other products. And we said there was going to be a correction. And then in March, April, the price of oil went down to $56. And we have three items on our checklist for buy and our table pounding buy signals. And one of them is the price of oil going below economics, which if you look at the Federal Reserve of Dallas, they have sheets in their presentations, and it comes in the mid 60s, some as low as, 58, some as, 70 for the different basins, but the average is in the mid 60s for the break even. Well, we got below that. The second one was we were looking for the S&P TSX Energy Index to go below 240, and the index at the time was trading at the high of the year was, at the beginning of the year was 288, and it went down to 214. It spiked down below the 240 target, and we were using that in April to be signaling the buy signal. The third one is the S&P Energy Bullish Percentage Index that we've talked about many, many times, and it was trading around 80% in January. And we said that we thought it would go down below 10% for a buy, below 5% for a table pounding buy, and it went down to 0%. The only time in the history of the index that it went down to 0%. It went in 2008 to below 5%, 3.7, and in 2020 it went down to the 4% level. So this was a fabulous buy signal and gave me the confirmation and the confidence to say table pounding buy. We put out a lot of buy recommendations then, and we said buy the sector. And as you said, the price of oil has done poorly, but the stocks were so ridiculously cheap, trading under 2 times cash flow, a third of NAV. I'll give you a few examples. On the natural gas side, things like Birchcliff were trading at 470, they're now 750. Bonterra, which is a oil and natural gas producer, 256 up to 458. One of the stars was in play, trading at 650, now at 1225. Hemisphere, a name that you guys know, great dividend, a penny a month, plus 2 3-cent specials during the year. So we're talking 18-cent dividend. The stock was trading at the beginning of the year or at the low of the year at $1.64, and now it's $1.97. So you picked up 30 cents in capital gain, you picked up 18 cents in dividends. That's a home run for yield investors. So another one was a name that we covered, that Strathcona, which had the natural gas assets and sold them to ARC and to Tourmaline, but the stock was trading at $23, and the high for the year was 45, and they just paid a $10 return of capital, just like Paramount did, when they sold assets to Ovintiv. So there's been a lot of home runs in the sector. You just needed to know where they are. The bargains were there. Sure, you can look at some names and say they didn't move at all, but the reality is, if you're a stock picker, which is what we are, and you focus on the names that are cheap, and you watch the companies, and you go see the companies, and there's going to be home runs. And I would think that the names I mentioned, leading by, in play and Strathcona, you got to say those were home runs in a year when everybody said gold and silver were the only places in AI. The reality is the energy wasn't so shabby if you were in the right areas.
Well, just all the more reason for folks listening in to check out the links down below for Joseph's different publications, because I do think it was a stock picker's market. And a lot of those stocks we've been talking about with you all year long, and you were highlighting for our listeners why you thought the value proposition was so promising. Let me ask you this, Joseph. If you think that we're going to have an inverse year next year, we went from, let's just say, almost $80 a barrel down to below 60. If we flip that script and go from a little under 60 to back near 80 again, what does that mean for the oil stocks in that environment? Have they priced some of that in already, or are there hedges in place that would come off? What would a move from 57 crude to $80 crude do for these oil stocks?
Well, what I'm finding quite amusing is that a lot of the companies, when they're talking about 2026, and most of them probably are going to wait till January, February to put out, once they see the reserve reports, then they'll put out their guidance. But the reality is a lot of them are shoving 55, others $60 in their 2026 forecast. I'm using $70. I think, we're going to see a rising price environment throughout the year. And just to give you an idea of what I'm thinking, I think Q1 we're going to be down. We might see a correction down to 52, so we're 57 or so right now, 57.80 now, with a range of 52 to 66. Q2 I think will go from a range of 62 to 72, so we'll peak over 70 again. In Q3 I think we'll range between 68 and $78 WTI. And then Q4, 74 to 84. So a peak over 80 in Q4. That's not in the market. Nobody believes that. Everybody is using way lower numbers. And even the big boys in the States are using like $60 WTI. And most people talk about a 3-4 million barrel overhang. That's bullshit. And we can go through that later. There is no overhang in the market. And inventories are not, excessive as the bears are running. Like there's three components to it. And one component, yes, is higher than normal, but the other two are not. So if you want to go through that, we can do that. But the bottom line is, I think that people are going to be surprised that OPEC does not have the production capacity to raise volumes very much. I think we're going to see tariff resolution, which means global trade will stabilize and we'll start seeing growth there, which means more demand. And if we really do want to go and have more data centers and increase the electrical grid in the industrialized world, and we're going to need more copper, nickel, aluminum, all these things, rare earths. And that's going to come from the third world, and they're going to want to have a better sustainable quality of life, which means they're going to use more energy. And to build those facilities, you're going to need more energy. And the people working there are going to want to have, running water, electricity in their homes. They're going to want to drive cars instead of bicycles and mopeds. So I think that the whole negative story is going to change. Like, think about the beginning of the year when we're $79. Everybody was saying shortage, and the price of oil is going to go up. And then then they started swinging to this 3-4 million barrel negative scenario. I think they're going to swing back to the fact that OPEC's got no more, inventories are coming down, and the bullish scenario comes back. And people don't realize how quickly things can change. And my comment to them is, just look what happened to gold and silver. Look what happened in 2025. All of a sudden, people realized, number one, it's a shortage. Number two, people don't trust the currencies anymore, especially the U.S. dollar, which was down, on the year. And they went into gold first and silver second, and then silver took off. So I think we're going to see, we've seen natural gas take off. It's $4.60. It had a high of $5.50. Last year was a $2 scenario, and it's taken off. So natural gas is leading the patch right now. And we have more data. We have more LNG plants coming on in the States. We have LNG Canada's over a BCF, heading to 2 in Q2. We got all the arguments in favor of things picking up. And there's data centers being built in Alberta, which means more demand within the province. So I think the story in natural gas is the best of the two, but I think oil is also going to be a star. And remember, companies are trading at 2 and 3 times cash flow on depressed commodity prices. You plug in $70 oil for the year and 80 annualized in Q4, you're talking a massive increase in cash flow. And if that happens, you're going to see multiples expand. So I'm looking for a lot of stocks in 2026 to be up 50 to 100%, and maybe some even better than that if they really have success with with their production levels. So I think that people should really take a serious look at the sector. You can go to large cap names. There's the big ones like Tourmaline and ARC. On the oil side, you can look at the Strathconas and Whitecaps of the world. On the drilling side, you can look at Precision Drilling and Ensign and Total Energy. There's lots of places. And then on the international side, you can look at Valeura, Gran Tierra. There's so many different places to go, Alvo Petro. And so we think that there's a massive shopping spree available. Again, people should decide what's appropriate for them based on the liquidity, dividend requirements that they have, market cap that they have. But we cover 31 companies. We're going to add one new one in our January issue because we have 3 takeovers in the last 2 or 3 months. We lost Kuwaitno for a takeover. We lost NuVista on a takeover. And we lost Step Energy on a takeover. So we're looking to add additional names that we see as bargains that can make people a lot of money in 2026 and the years thereafter.
So, Joseph, it sounds like a totally different year next year, and even from the last couple of years in the oil space. And yes, I understand a few stocks have done well over the last few years, but quite frankly, it hasn't been like the gold or silver space where everything has moved up multiples from where it was earlier this year, even a couple of years ago. Look, you shared with us real quickly there some of the stocks that you like, but let's spend a bit more time on different stages, different types of stocks in the sector, because that's what our listeners really like to hear. So first and foremost, large caps, the balance between U.S. large caps or Canadian large caps. Where do you see the best opportunities in those types of stocks?
Well, the American stocks are cheap, but the Canadians are much, much cheaper. And there's 2 reasons why we're cheaper. One, the political situation in Canada. People aren't sure if they believe Carney, Prime Minister Carney, and what they're going to do. This whole carbon capture thing, is there going to be a pipeline west? There's still a lot of debate on that. So, we are cheaper for that reason on the political side. And then on the other side of it is we really aren't having the growth right now in the volumes of the sector, while the U.S. numbers in many cases are showing volume growth because of the LNG takeaway in the U.S. South. We really haven't seen that until the LNG Canada. So when we see the Q4 results coming out February, March of 2026, I don't think we're going to see many companies, unless those made acquisitions, are going to show comparisons that are positive versus Q4 of a year ago or Q3 of 2025. So I think that's going to be a holding pattern for the stocks until they start showing more production growth, cash flow growth, and those that still have debt problems, that they knock the debt down to under 1x debt to cash flow. So there still are a few companies with debt problems, but they're all focused on paying it down. Those that are in very healthy shape are all talking about, NCIBs, normal course issuer bids, buying back their stock. We haven't talked about Trican on the service sector, but they've bought back, since they announced their NCIB, they bought back more than half their shares. So the remaining shares, there's massive value there. It's trading at $591. The low for the year in 2025 was $369. So it's had a good year, paying you a dividend, and there's less shares outstanding. So as the company does well in the outlying years, that's going to be incremental to less and less number of shares, which is positive. So let's go to the big cap names. And again, any company that I'm talking about big cap is over $2 billion in Canada. The largest is Tourmaline, $24.6 billion. They produce in Q3 635,000 BOEs a day. They have a base dividend of $2.50 a quarter. So we really think that's an attractive name for people to look at. And, we're sitting with Tourmaline, an $80 1-year target and a $150 bull market peak target. Birchcliff on the natural gas side, we're looking at a $2 billion market cap. We're looking at a $9 target. As I mentioned, the stock had a very good run from the year. Its low for the year was 471, 754. We'd like to see that back off, below, 6.25. If I'm right about a market correction, that could happen. And we're sitting with a $9 1-year target and a $25 market peak target. And I think it's going to get taken over. There's, names like Trican that we mentioned, Vermilion Energy, which is more oily, $2 billion market cap. The stock, is trading It's had a decent year. The low for Whitecap was 687. It's now 1150, and we have a target on Whitecap of $14 this year, 25 bull market peak. So you can see there's some great names, but the important thing to think about is dividends. We've talked about Freehold before. It's trading, the last count I did for my run, 7.1% dividend yield. You have Whitecap with a 6.3% dividend yield. And then if you go to names like Marin Energy, which is a $1.2 billion market cap, a 10.9% dividend yield, Surge Energy, which you guys know very well, 700 million market cap, 7.3% dividend yield, monthly dividend equal to 52 cents annualized. On the stock on Surge, the low for the year was 437. It's now 691, and the high of the year 785. So another story that, if you want dividend income and market cap and liquidity, you've got that. If you're looking for growth stories, there are names that can fit that bill, which we really think people should look at. And growth is hard to find in the sector, so I think that's something that we're looking at in our names. And then the service sector, because if the industry does well and utilization goes up, day rates go up, both for fracking and drilling units and service rig units, and that's going to be a leverage to make those stocks do well. And, as we talked, Precision, Ensign, Total Energy, there's a lot of names there. Total has a dividend, the others do not. A moderate dividend, but still a dividend of 2.6%. So there's lots of things for people to look at. And, on the international side, we like names like Valeura, which is offshore Thailand. We like Alvopetro, which is onshore Brazil and some production in Canada. Gran Tierra, which is Colombia, Ecuador, and Canada. So there's lots of ways for investors to invest in the patch. And, I think that if I'm right about the price of oil getting over 70, I think that's going to be the catalyst for the stocks to react, which is Q2. And then in Q3, as we start seeing 70s on a consistent basis, and then that's going to be when I think multiples start expanding. And really in Q4, when they see an 80 handle, that's when you're going to really see the trajectory of the stocks take up. So you want to buy them in Q1 if we have this correction. My guess is it could be between February, March, April, down below 50s, 54, 52, 54 at the low for oil. I think the S&P TSX Energy Index, which is now at 297, goes below 240. And the S&P Energy Bullish Percentage Index, which has come off 70%, it's 49% now. I think it gets below 10%. And with a little bit of luck, if it gets below 5%, it makes my conviction even higher.
Well, Joseph, you covered a lot of ground there with the big caps, the dividend-paying stocks, some of the service companies, international. When you hit growth, though, you kind of shot through it. So let's focus on the growth names, the ones that have the best growth wedge for 2026.
Well, that's where I have a little bit of a problem, because a lot of them this year, because natural gas prices were very low, you didn't see much growth. But I'll give you a few that do have growth, into the end of this year and then much more in 2026. Paramount Resources, which is, sold assets to Ovintiv, but the remaining assets, they've got a very strong growth profile to them. So we like that name. Whitecap Resources has got growth planned of, 5% in their numbers. Bonterra, we see much more growth in 2026 than in 2025. Obsidian Energy, after their sale to InPlay, they're now from their base after the sale are showing signs of growth. Pinecliff, which didn't do any drilling in 2025, held off because they were waiting for gas prices to recover. They're now starting to drill again, and we'll see the results starting in Q1. Surge Energy, which is that kind of flattish production, they should start showing some growth in 2026. And then you go to some other names. InPlay Oil will probably have flattish production in this year, but 2026, as they get their debt down, they're going to start showing some growth. Petrus is another small cap, 250 million. That's 9,000 BOEs and 9,800 BOEs a day in Q3, could punch through 10,000. Rubelite, which is 12,400 BOEs a day, mostly Clearwater heavy oil. They should start showing some growth. So, and then Yangara Resources, which is Cardium, 9,500 BOEs a day. They should show a little bit of growth. So 2026 is where the growth comes in. For companies that had debt, their focus will be on early part of 26, first half, pay down debt, and then the second half start drilling. And as I mentioned, Pine Cliff has already started drilling because we're looking at over $3 ACO right now, which they can make money on. So they're also looking at light oil prospects, that have natural gas as well. So they're looking at dual product performers in their drilling program. And Phil Hodge, I think you guys know, you've interviewed him many times. He was very prudent during the tough years, and now he's pressing on the gas pedal rather than the brakes.
Okay, Joseph, a lot of companies there to consider. How about ones that are more of a blend of oil and natural gas? If natural gas, since that has done well, if that has a positive outlook as well, do you like those stocks that are more less pure play, more, I guess, balance between the two?
Well, if you look at Paramount, it's 48% liquids, 52% natural gas. Vermilion is 33, oil 67. Whitecap is 61.39. Bonterra's 51 liquids, 49 natural gas. I'm just going through the mix here, and I'll read off the ones that are potentially mixed. Questair 52% liquids, 48 natural gas. And then you've got Yangara, 42% liquids, 58% natural gas. So a few of those there that have the mix that can do well in 2026 with higher natural gas prices. I'm using, I think this year, the average for natural gas is going to be somewhere in the 240, 250 range. Again, I don't have the Q4 numbers now, but the numbers were in that handle. I'm using 325 in my numbers. We're right now 315 in ACO today, and I think we're going to see better pricing in the second half of 26 because LNG Canada will be running full out. Data centers will be on using more gas. And I think storage will come down sharply. We're seeing, quite a bit of storage down in the States. I pulled out the numbers from EIA today, and we just had another 166 BCF taken out of storage, 3.4 TCF now, and it's 3.6% below a year ago, which was 3.54. The one that I've been waiting for is get below the 5-year average, and this week it happened, down 0.7% to 3.43 TCF. And that, if you remember at the beginning of the year, was 8 or 9% above the 5-year average. We're now, for the first time, below that 5-year average, which sets up natural gas to be a very strong performer, in the U.S. market, NYMEX, in 2026. And if that's the case, they'll be drawing from Canada because they need it, and then Canada will be drawing more to the West Coast because the LNG's there, and then data centers, electricity needs. I think the bad news for natural gas in Canada, stranded gas, is now over. And I think we'll see that being the reason. And that's the reason why some of the names like NuVista got taken over. It was $11 in April when we recommended it, and it got taken out at $18 by Ovintiv. They bought out from Paramount. They bought NuVista out because Ovintiv, the old Encana, wants to be a very big player in the Montney and the Duvernay and wants to be a very big player in the export market to LNG.
Well, Joseph, that brings up an interesting point about capacity and pipelines, and some of the oil service companies, benefit because their pipelines are full, but is there opportunity for growth in pipelines? Could you maybe speak about that aspect of Canada and getting more gas or fluids to different areas with pipelines?
Well, the problem is the costs of them have just gone, stratigraphic. On the oil TMX, you know how that was like a 3-bagger, 4-bagger more than the initial estimates. Coastal Gas was a massive overrun, and TransCanada had to take a big write-down. Small tweaks, adding compression, you can do that and keep the costs under control, assuming, you can get Caterpillar equipment, which is, an 18-month lag now, given the backlog they have. So I don't really see major pipeline expansions in Canada for a number of reasons. One, the cost overrun. Two, the federal government not so keen on liquids. And number three, the First Nations have to buy in. And right now, the First Nations have said no dice for an oil line in the northern part of BC. And add one more. The Premier of BC doesn't like the idea either and is crapping on that idea.
Yeah, it's kind of a mess over on the West Coast. And hey, I live in Vancouver. It's always kind of disappointing to read what's going on. But one more, I guess, on the stock front is M&A. You even mentioned you had, 3 recent takeovers just in the stocks that you cover. What's your outlook for M&A into 2026?
Well, as we see the more the FIDs, final investment decisions made on LNG Canada 2, which will add another 2 BCF, which could come on below before the end of the decade because the basic facilities are there. Then you've got the issue of, Kissimmee, Cedar, all of these pipelines, get their final decision and start doing construction. Then you're going to have more takeaway capacity, and they're going to want to lock in 20, 25-year contracts for the gas so that they can export and have export contracts to Asia, to South Korea, to Japan, to China, to wherever. And so we're going to see more and more M&A and more consolidation of the plays, going forward in the next few years. And, both the Montney, the Duvernay, and, all the way from, West 5 in Alberta all the way into Northeast BC, the whole fairway is there. And there are smaller players that can be consolidated, that potentially Birchcliff, Kelt, there's so many names you could throw out there that advantage that all could be taken over if there's a merger mania phase and people need to lock in long-term reserves. That all will help the sector going into the next few years. And I think also if you are in an area, like the Charlie Lake, which is light oil, and people want that play and they want to own light oil because differentials widen between light and heavy, then you're going to see, consolidation of that. And companies that have pieces of the Charlie are going to see themselves and people knocking on the door to say, look, I want to consolidate the land. I want to consolidate the play, lower the operating costs, make more money. And, that's where do you find oil? Wherever there's oil, next to you, instead of going to find a whole new play, is just consolidate the plays around you.
All right, Joseph, we'll wrap it up here. Thank you so much for taking all that time you did with us last year in 2025 and now early on in 2026. Sounds like it could be a very different year for the oil sector. And again, it's just been interesting to see broadly the stocks hold up better as the oil price has been drifting lower and lower year after year. Hey, we're going to keep following up with you throughout this year, and I hope everybody does click that link in the show notes to visit your website, learn more about the Schachter Energy Report and Ion Energy, and sign up with you. So, Joseph, thank you very much for your time on this weekend show. Happy New Year, everyone. Thanks for tuning in to this weekend show. Hope you all had a very happy New Year and are looking forward to 2026.
Happy New Year.